Morning, sir.
Morning. And in the last couple of weeks, we have discussed about valuation of uh, bonds and valuation of preference shares. And another major section of this chapter is valuation of ordinary shares. We have already studied what are the special features of ordinary shares and how it differs from bond and preference shares. Um Valuation of ordinary shares is different from the bond and or preference shares. So I think we have discussed single period valuation and multi-period valuation. Single period valuation means uh, suppose an investor purchased the share today. Single period valuation means an investor purchased shares today and keep the shares for 1 year and sell it. During this period, he will receive two types of income. The first income is the dividend. If the company declared any dividend, so that dividend will be considered as income, dividend income. Another income is capital gain. Capital gain means due to the appreciation of share price, he may get that sort of profit. So single period valuation simply means the investor keep the shares for 1 year. During that period, he will get two types of income, dividend income and capital gain. So we have discussed this kind of example in the last class. Uh, and if you want, I will do it again with a little explanation. Right. Now let us assume that an investor intends to buy a share and will hold it for 1 year. Note it down. Here, he hold the share for 1 year. Suppose he expects the share to pay a dividend of 2 rupees next year and would sell the share at an expected price of 21 at end of the year. If investors' opportunity cost of capital or required rate of return KE is 15%, how much should he pay for the share today? So here in this example, there are two types of income, dividend income as well as capital gain. So I ask question, how much dividend income and capital gain, how much? Dividend income, how much? Dividend income is 2 rupees. Dividend income is 2 rupees and capital gain is 1 rupees. He has purchased the share for 20 rupees and no, they not give you they will give you the beginning purchase price. Anyhow, to find the value of share today, as for P naught mean price of the share today, P naught, the 0 means today, equal dividend 1, D1. D1 mean dividend for the next year, not 0, right? This is here 1, right? 1 year from today. And P naught, sorry, P1 mean price end of the first year. And 1 plus KE, 1 plus cost of equity, right? In this example, dividend is 2 rupees plus 21 is the price end of the period, 21, end of 1 year. It's P1 and D1 is 2 and 1 plus KE is 15%, so 0.15. So 1 plus 0.15 equal 1.15. So when we solve this equation, we will get price equal 20. So this is an example for single period valuation of ordinary share. Then we'll move to and also I have explained what is undervalued share and overvalued share in the last class. And multi-period valuation. Multi-period valuation mean an investor hold the share more than a single period, more than 1 year. He may hold the share for 2 year, 3 year, 5 year, 6 year, and then they sell it to other investor. Right? It simply means an investor hold a share for more than 1 year. The following is a general formula to calculating the value of share. P naught price today equal summation of dt. dt means here year one, if the investor hold the share for 3 years, d1, d2, d3 like that. And ke is the cost of equity. And pn, if the investor sold the share after 3 years, so we have to put here p3, price at end of year 3, and 1 plus ke, n, number of periods, n. And sometimes the questions will come up with dividend, come up with growth. There are two types of growth: normal growth and supernormal growth. So how do we calculate growth? Retention ratio into return on equity. Retention ratio means um, 1 minus DPS over EPS, called it retention ratio. Return on equity means ROI, ROE. G simply B. B means retention ratio, or sometimes called clawback ratio, into return on equity. The second one is supernormal growth. To find out the value of the price of the share today, P naught. P naught means price today equal D1, dividend for the next year, divided by KE minus G, cost of equity minus growth rate. Right? Here, the share value equal present value of dividend during the finite supernormal growth period plus present value of dividend during infinite growth period. Right? Let us do one example. Right? Suppose that the price of a share today, P naught, is 20 rupees. The current price is 20 rupees. And it is expected to increase at an annual rate of 5%, and it is also expected to grow at a rate of 5% per annum. Right? There are two increases but the same rate. The first increase is the share price increase. Right? The share price every year increases by 5%, and also the share dividend also increases by 5%. That is growth rate. And the price would equal the present value of dividend for 5 years. Right? The first 5 years he keeps the share. Price would The price would equal the present value of dividend for 5 years plus the present value of the share at end of 50 year here. So I have done this example in Excel sheet in the last class. So are you expect to do again? The present value of the stream of dividend. Here, this part, there are two parts, right? So this part, the first part is in the bracket is the present value of dividend for 5 years. And here, this is the present value of share price at the end of 50 year. Right? Anything to ask? Do you want me to do again?
Yes, sir.
Okay, I will. Yeah, this is the formula. Right, this is the formula. Uh, can you see the Excel sheet? Is it visible to you
No, sir.
now?
Now, okay, sir.
Okay. Now this is the formula to find out the price of the share today. P naught equal summation of the total of dividend for t periods. Uh, in this example, there are 5 years. Therefore, the t start from year 1 to year 5, t5. Then 1 plus cost of equity plus price n. In this example, n equal 5 because the shareholder hold the share for 5 years, and 1 plus ke here the n 5, right? And here today's share price is 20, isn't it? The price is 20. The share price increases by 5% every year. Therefore, the price will be increases by 5% every year. Therefore, the price P1, right? P1 20, sorry, P naught 20, P1 21, P2 22, P3, P4, P5, like that, right? It increases by 5%, by increases 5%, right? And the dividend also increases by 5%. The growth rate is 5%. Therefore, uh, the dividend also expected to increase by 5%. So first year, next year dividend D1 is 2, and this D2, the dividend also increases by 5%. Therefore, 2 into 1.05 year 1, like that. So likewise, we have to we already calculated D1, D2, D3, D4, D5, D6. And this is the KE, right? KE mean here 1 plus KE means 1 plus KE means 0.15, right? Here in this example, when you look at the slide here, this is 2 rupees is D1, and we have to convert this 2 rupees, this 2 rupees, this 2 rupees is a future value because it will be received in next year. To convert this future value into present value, we have to discount by 15% because cost of capital, cost of equity is 15%. So when we convert this, we have to write like this. And here 2.2 rupees and 10 cents, 2.10. This is future cash flow, future dividend. To convert this value into present value, we have to discount by 15%. Likewise, year 3, year 4, year 5, right? So first we have to calculate present value of future dividend. So this part, first part of the formula. Right here, we already calculated dividend, and this is uh, discount effect. When we convert this future cash flow into present cash flow, we will get present value of the dividend, right? Present value. Right. Then how much? Year 1, 2, 3, 4, 5. How much? Here, how much? Here, D1, D2, D3, D4, D5. So this part, first part of the formula. How much total? Not this. How much? The total is 7.309, right? So this is the first part. This is the present value of dividend. Present value of dividend, future dividend. And right, and here the second part of the formula. Second part of the formula is PN. PN mean here he hold the share for 5 years. Then we have to find out the price in the fifth year. Here P5 is 25.53. 25.53, and we have to convert this future value in the present value. So to convert this value, here this is here this is the future value, and multiplied by this is the discount effect. This is the discount effect. Right. How much? 11 point uh, PN. 25. Then how much total? This value is what present value of uh, present value of the share at year 5, right? Then total how much? Present value of future cash flow of dividend plus present value of price 18.25. Sorry, right? Not this value, right? Not, we have to take right. Here I have taken 1, 2, 3, 4, 5. We have to take this value, right? 20, right? The answer is 20. The value of the share P naught today is 20, right? Understood? Answer here also 20. Here 20. Answer here 20. So it has two parts. First part is the finding present value of future dividend, and second part of the formula is find the present value of uh, price of the share at 50. Right? Clear? Clear? Anything to ask, please? Any queries you can ask. Right. Then we move to the next slide. Growth in dividends. Earnings and dividends of most companies grow over time, at least because of their retention policies. Right? Normally the share earnings of the company is increases over the period of time because of their retention policies. Retention mean the companies earn a certain amount of profit. Out of this profit, a part of such profit will be distributed as dividend. The balance part is retained within the organization for the purpose of internal development of the company. And right, there are two types of growth, as I explained today morning. Normal growth and supernormal growth. Normal growth means we can expect some growth. It's a normal growth, right? For example, um, right. Um, for example, what say during the COVID-19. Normal growth and supernormal growth. Here, the normal. So I will give you an example. Right. Yeah. In the COVID-19, the mobile network companies, say internet providers, they have earned normal profit or supernormal profit. The dialogue SLT, mobile broadband service providers like others, they earn profit. Is that normal profit or supernormal profit?
Supernormal profit.
Supernormal profit. During this period, they will earn supernormal profit. Then, when we compare with other periods before COVID-19, they have earned a normal profit. So the normal profit, so normally companies grows all the time. Say before COVID-19, the growth rate may be 5% from 2010. 2010 to 2020, the companies are grow normally. From 2020, the growth rate of profit may be 20%, 50%, like that of the income. So this is from 2020, from 2022 to 2025. They may have supernormal growth because of the COVID-19. Many people are work at home, and many people are stay at home, and they are doing their work at home, right? So therefore, the network requirement is high, demand is high. Therefore, they earn a supernormal profit. After the 2025, the world becomes normal, and then again they will get the normal growth. Then the supernormal growth is come down, and they grow as normally. So this is the difference between normal growth and supernormal growth. Right. If a totally equity finance, total equity means 100% financed by equity shares. If totally equity financed firm retain a constant proportion of its annual earnings, it's called B, right? Say EPS is 10 rupees. Assume that EPS is 10 rupees. Out of this 10 rupees, a company pays dividend 4 rupees. Then how much retention? 6 rupees. Right? If company earns 10 rupees per share, 4 rupees paid as dividend, then balance 6 rupees will be retained within the company for the purpose of growth in the future, and reinvest its internal rate of return. Right? Again, the 6 rupees will be keep within the organization for the purpose of investment, which is its return on equity. Right? They will invest within the company at the rate of return on equity. Then it can be shown the dividends will grow at constant rate equal to product of retention ratio and return on equity. Right? Normally, how to calculate growth? Growth equal G. Right? G equal retention ratio, that's B, and into return on equity. Yes, here G equal growth equal B, retention ratio into return on equity. In your example, if there are no information regarding G, that time if you have to calculate based on the information of retention ratio and return on equity information. Right, now we will see one example on normal growth. Suppose the book value of a firm's equity per share is 100 rupees. Book value of the share is 100 rupees. And its return on equity is 10%. ROE is 10%. He firms the firm's retention ratio is 60%. 60% mean if company earns 100 rupees as earning, 60 rupees will be keep within the organization, balance 40 rupees will be paid as dividend. That's the meaning of 60% retention ratio, which implies a payout ratio is 40%. Payout mean DPS over EPS. Let us also assume that the firm has no debt. It's mean 100% fully equity financed company. The firm's earning per share after 1 year will be how much? 100, right? EPS 100. It will be grow by 10%, right? It is expected that the firm will be earn 10% on its retained earning, right? ROE is 10%. Let us also assume that the firm has no debt. The firm's earning per share after 1 year will be EPS is 100. It will be grow by 10%. Therefore, the EPS will be 10 rupees. The firm will retain 6 rupees because their retention ratio is 60%. So 10 rupees into 60% is 6 rupees, and distribute 4 rupees as dividend. The book value of equity per share in the beginning of second year will be a book value, it was 100 rupees, and 6 rupees will be retained within the organization. Therefore, book value of the share will be 106. The firm's EPS in second year will be EPS 106 into 10%, it equal to 10.6. Again, it will be retained 60% of the earning, like that, right? This is how the dividend is grow, right? You can refer this slide with yourself, right? Now, perpetual growth model. Perpetual, this is important, right? Perpetual mean, as I told you earlier, uh, infinitive period of time. Perpetual, right? If company grows by 10% every year, this 10% is continue forever. That's normal or supernormal, not like that. It continues forever. 10% means 10% forever. Say the last year company pays a dividend 10 rupees, the next year will be 11 rupees, and the next year will be 12.1 rupees, like that. The present value of future, when in case of perpetual growth model, the present value of a share is equal to the dividend after a year. Dividend after a year means dividend after 1 year. It is called DV1. DV1, dividend end of 1, divided by the differences of capitalization rate, cost of equity, and the growth rate. Here normally simple formula. This is the simple formula to find out, right? This is the formula to calculate value of the share which pays a dividend with growth forever, right? This is the formula. Here K is the cost of equity, G means growth, right? So it has assumptions, right? It has this formula has developed based on some assumptions. It is based on the following assumptions: the capitalization rate or the opportunity cost of uh, capital, that's mean KE, right? The KE, cost of equity, must be greater than the growth rate. KE should be greater than growth rate. Otherwise, absurd result will be attained. If KE equal G, the equation will be yield an infinity price. And if KE is less than the growth rate G, the result will be negative prices. So the main assumption is all the times in this model, cost of equity is higher than their growth rate. The initial dividend per share DV1 must be greater than 0, right? The relationship between cost of equity and growth is assumed to be remain constant and perpetual. Right. Let us work with this example. A company paid a dividend of 3.7 in the previous year, right? You have to be very careful. You have to clearly understand what is the next year dividend, what is DV1, what is DV not, DV0. The company paid dividend 3.7 in the previous year, previous means last year, D0. The dividend in the future are expected to grow perpetually. Here, perpetual means infinitive growth, perpetually at a rate of 8%. Find out the share price today if the market capitalization dividend is 12%. Right? We will do this in actions. Right? Now we want information on cost of equity. KE, how much? It's 12%. G, how much? G, perpetually by 8%. G is 8%. And D naught. D naught, it was 3.7. And that's all. Right? Then we have to calculate price of the share today. Price of the share today. Right? So this is the exam. This is the formula. Right? This is the formula. P naught equal dv1 divided by k minus t. First we have to find out dv1, d1. Right? Here we know d naught. So we have to calculate d d1. We have to calculate d1. How to calculate d1? Yeah, p d naught. D naught how much? This is d naught into 1 plus growth rate, 1 plus g, 1 plus g. G is 8%, mean 0.08. After how many years? 1 year, right? After 1 year, right? 4 rupees dividend, right? Here we have found d1. Here d, so d1 equal dv d0 into 1 plus g, right? d1, and we have to find k minus g. K minus g, ke minus g equal how much? Cost of equity ke is 12% minus g is 8%, 4%. Then P naught equal D1 divided by K minus G. Simply the answer is 99.99. Yeah, 100, right? Any questions? Any questions? Please, we can ask. Right. Now let's move to supernormal growth. Right. The dividend of a company may not grow at the same constant rate infinitively. Right. It's impracticable. Right. A company continuously grow infinitively. Perpetual growth is rare. It may face two-stage growth situation. For a certain period of time, is grow normally, and also and other period of time grow at supernormal rate growth rate. Or for a first period of for the first period of time, grow at supernormal growth at higher rate, then it's come to the normal growth. In the first stage, dividends may grow at a supernormal growth rate when the company is experiencing a very high demand for its product and is able to extract premium from customers. Afterwards, like for example, this COVID-19 period, this COVID-19, the company, network providers, internet providers may earn a supernormal growth. They enjoy a supernormal growth for a period of from 2020 to 2023, and then the growth becomes slow down, and right, that slowdown may be considered as a normal growth. Right. Afterwards, the demand for the company's product may normalize, and therefore earning and dividends may grow at normal growth rate. Right. The supernormal growth. The share value in a two-stage growth situation can be determined in two parts. Right. In case the questions come up with the two period. First period come up with supernormal growth, and the second periods come up with a normal growth. The first, we can find the present value of constantly growing dividend annuity for a defined supernormal growth period. First, we have to find the present value of uh, constantly growing dividend annuity for a defined supernormal growth. So the supernormal growth is not be forever, right? Supernormal growth be for a small period of time. It may be 2 or 3 or 4 years. Second, we can calculate the present value of constantly growing dividend infinitively, perpetually, right? Once the growth rates come from supernormal to normal growth, this normal growth is constantly be forever. Second, we can calculate the present value of constantly growing dividend infinitively in perpetuity after the supernormal growth. Right. Let us do an example with supernormal growth. A company earned 6 rupees per share. Company earned 6 rupees per share and paid 3.48 as a dividend. Right? We will extract the information. Right? So this is the question. We will move to process it. A company earns 6 rupees per share, right? Has been EPS 6 rupees, and paid 3.48 per share as dividend in the previous year, right? D D naught is 3.48. Rupees 3.48. Its earning and dividends are expected to grow at 15% for 6 years. Right, growth for the first 6 year, it's mean supernormal growth, supernormal growth, right? Supernormal growth. How many people? How many? At 15%, 15%, and it's lasting for 6 years, right? Supernormal growth lasting for 6 years, and then the rate of 6%, 8% infinitively. So normal growth at 6%. The capitalization rate, KE, cost of equity, it was 18%. Right? Have you got an idea about the question? Have you got the idea about the question? First, understand the question. The question is, we have to calculate price today, P naught. We have to find out P naught. Right? We have to find out the P naught. In this question, G 2 times comes. Supernormal growth G at 15% and normal growth G at 8%. Not 8%, it's 6%. Oh, sorry, it's 8%, no? Right? The questions look small, but we have to work, we have to do a lot of working to find out the value. Right? Okay, I will make it simple. Here, 2 steps. First, we have to find the present value of the share during the supernormal growth. Right? First, we have to find out supernormal growth. So I can show you. Yeah. Right, this is a timeline. Right? Yeah, here T0. Right? T0. The first 6 years, the growth rate was 15%. Growth rate was 15%. Right? Then after 6 years, the growth rate has become normal into 8%. Right? The question is we have to find P naught, price of the share today. So first we have to work on this period. This is stage 1, and then we have to work out on this. This is stage 2. Right? Okay. Now let's move to our work. Right? First, we have to find the present value of the share during the supernormal growth period for the first 6 years. Right? The P naught here, summation of the dividend D naught into 1 plus G, supernormal growth for the period of T, and 1 plus KE. So first we will find that, right? First we will find that part. Right, and let's work out. We find right, D. We want D1, D2, D, D2, D3, D4, D5, D6, D7, D8. Right, and we want D naught. How much D naught? D naught equal 3.48. 3.48. This dividend will grow at 15% for 5 6 years, right? This growth rate will be for 6 years, right? Then this value 3.48, it will be grow by 1 plus G. How much G is 15%, 0.15, right? This is D naught. 1 plus G, G is 0.15, number of years, T1, right? So here 1, D1, D2, D3, D4, D5, D6, right? When we put equal sign, we can get, right? And we have to convert, right, D6, right? Here up to 6 years, we will get growth. We have growth rate at 15%. After 6th year, the dividend rate will be not 15%. It will be, it become at 8%, right? Not 3.48, 8.05, right? I will come to the point again later at this point. Then we have to find the present value. This is cash flow. This is future cash flow, right? Then we have to find out discount. Discount factor, that's mean cost of equity is 18%, right? 18% here. How to calculate? 1 over 1 plus 1 plus KE. KE here 18%, 0.18. It's for year 1, year 2, year 3, year 4, right? So KE, this is KE. This is called what? KE. Then you calculate equal sign. Then we can find the present value of future cash flow, right? Present value of D1 into cost of equity, 1 plus KE. Then this is the present value. See the answer. Mm, So we have to take the total value, right? Total value. Right, 19.10. Have you got the correct answer? Right? We have taken 19.10. 19.10. So answer, our working is right. Right? We have come to the first stage. And we have finalized it, and we move to the next. That is, we have to calculate the second stage. Right? Second stage, we have to calculate the present value of the share at end of sixth year. Present value of the share at end of sixth year. The growth being at 8%. Right? This is the formula. And second stage, right here, we have to calculate P6. P6 mean end of sixth year. End of sixth year, it becomes the normal growth. So first we have to find out the price at P6, end of sixth year. What's the price? Then we have to convert this value into present value. Right? First we have to find the P6. P6 is the future value of the price, share price. Then to convert the future value in the present value, we will use 1 plus KE, right? Right. So first we will find out P6 first, right? P6 equal P6. P6 equal, right? First we have to find out D7, right? In the D7 we already calculated 13.98. So we can find this D7 in another way, right? Equal D7 equal, we know D6, right, into 1 plus KE, sorry, 1 plus G. G in the during the year 7, G was 8%. Right? Then so D6 here is how much? 8.05. 8.05. Right. Yes. This is the correct answer. Right. Right. The D7 is 8.694. Right. So D7. Right. First we have to take D7 equal this value, right? D7 value, and KE was 8%, 8%, not 18%, and G equal 8%, right? And KE minus G equal KE 18% minus G 8% equal 10%. Therefore, P6 is simply P7 divided by KE minus G, 86.94. Check the answer. Right. Here we have taken the answer. 86.9. 86.9. 86.9. And this is the future value, right? This is the future value. Then we have to convert this future value into present value. How to convert present value? How to convert to present value? We have to discount by KE. Right, this is the future value. Then we have to multiply 1 plus. Right. Right. 1 plus 1 plus KE is 18%, 0.18. So this cash flow will be incurred in after 6 years. Then we have to put 6. Right. Then the present value of P6 is equal future value into this 32.20. Check the answer. 32.19. Here we have taken right 32.21. Right. This is the second part. Now we will combine both stage 1 and stage 2. Here this is stage 1. Right. Present value of future dividend. This is present value of this share price. Then we will combine both. This one plus this. How much? 51.P6 equal 51.3. Right. The answer is 51.29. Right. Any questions, please? Any questions? Any questions?